Welcome to Chapter 5 of our comprehensive lecture on income tax planning, focusing specifically on gross income from employment. Authored by Thomas P. Langdon, Evance Grange, and Michael A. Dalton, this chapter forms the foundation for understanding how various types of employment income are treated for tax purposes. As we progress through these slides, I encourage you to take notes and reflect on each concept, as these principles will be key for your overall grasp of income tax strategies. Let's start by defining what counts as gross income related to employment. In simple terms, any compensation you receive for services performed is included in your gross income. This covers salary, wages, self-employment or business income, fringe benefits, commissions, fees, tips, and essentially anything else you receive in exchange for your work. Understanding this broad definition is crucial, as it forms the basis for what must be reported to the IRS. Now let's explore foreign earned income and its exclusion rules. If you're a qualified individual with a tax home in a foreign country, you may be able to exclude a portion of your foreign earned income from US taxation. To qualify, you must either be a bona fide resident of a foreign country for an entire taxable year, or be physically present abroad for at least 330 days in any 12-month period. For 2025, the maximum exclusion is $130,000. To clarify those qualifying criteria, being a bona fide resident means intending to work in the foreign country for an indefinite or long-term period and establishing permanent living quarters there. Alternatively, the physical presence test requires spending at least 330 days abroad within any 12-month window. The period can start on any day. Importantly, if you don't meet the full year, the exclusion is prorated based on your days abroad. Let's look at a practical example. Suppose Connor lives and works in France for 340 out of 365 days in 2025. Because he meets the physical presence test, he can exclude a portion of his foreign earned income. The exclusion is calculated as a fraction. 340 days divided by 365, multiplied by the $130,000 maximum, resulting in $121,096 he can exclude from his gross income. Foreign housing costs can also be excluded under certain conditions. If your employer pays for your housing while you're working abroad, you may subtract total housing expenses minus a base amount, 16% of the annual exclusion, from your taxable income. However, this exclusion cannot exceed 30% of the maximum foreign earned income allowed and will reduce your overall foreign earned income exclusion by the same amount. When dealing with foreign income, US taxpayers have several options. They can use the foreign earned income exclusion, up to $130,000 in 2025, claim a tax credit for foreign taxes paid, or deduct those taxes if eligible. Notably, deductions for foreign property taxes are suspended for tax years between 2018 and 2025 due to recent legislation. Each approach has distinct benefits and applies differently depending on your situation. Fringe benefits are another important aspect of employment compensation. Generally, these benefits are taxable unless a specific exception applies. For excluded benefits like health insurance or retirement plans to remain non-taxable, they must usually be offered on a non-discriminatory basis. If highly compensated employees get access to benefits not available to others, the benefit becomes discriminatory, potentially causing some or all employees to lose their tax exclusion. Highly compensated employees, or HCEs, and key employees have special definitions under tax law. An HCE typically owns more than 5% of the company in the current or prior year, or earns over $160,000 in compensation for the relevant plan year. Key employees include those with greater than 5% ownership, over 1% ownership with compensation above $150,000, or officers earning more than $230,000 in 2025. Employer-provided medical benefits have specific tax treatments for both employers and employees. For instance, when employers pay health insurance premiums or reimburse medical expenses within the same year they're incurred, these amounts are deductible for employers and excluded from employees' income. However, if reimbursements happen after the year expenses are paid and itemized deductions were claimed previously, only part may be excluded under the tax benefit rule. Otherwise, it could become taxable. Let's compare Archer Medical Savings Accounts, or MSAs, with health savings accounts, known as HSAs. MSAs were available from 1996 to 2005 for small employers, while HSAs have been accessible since 2006 and can be set up by either employers or individuals. Both require a high-deductible health plan, but their contribution rules differ. MSAs cap contributions based on deductible percentages, whereas HSAs set annual dollar limits, $4,300 for individuals and $8,550 for families in 2025. Early, non-medical withdrawals are taxable and face a 20% penalty for both. Health savings accounts come with specific rules worth noting. Contributions aren't tied to your deductible amount. If you're eligible at the end of the year, you're considered eligible for the entire year. You can make a one-time, tax-free IRA distribution to fund your HSA if you stay eligible for 12 months. Employers may also make a one-time transfer from a health reimbursement arrangement or a flexible spending plan. These options provide flexibility and can help maximize your tax benefits. Life insurance premiums have different tax treatments depending on the policy type. For permanent insurance, any premiums paid by your employer are taxable to you as income. With group term insurance, the cost of coverage up to $50,000 is excluded from income. But if coverage exceeds that amount, the excess is taxable. If a plan favors key employees, those employees must include the full cost in their income, using either the table value or actual employer cost, whichever is greater. Here's a look at the Uniform Premium Table, which sets monthly insurance costs per $1,000 of death benefit by age. As age increases, so does the monthly cost, starting at just 5 cents for those under 25 and rising sharply to $2.06 for individuals 70 and older. These rates help determine the taxable value of group term life insurance when benefits exceed $50,000. Understanding these costs is essential when planning your employer-provided coverage. Let's walk through an example using group term life insurance exclusion. Khabib's employer gives him $80,000 in coverage at age 56 without charging him any premiums. He can exclude the first $50,000 of this benefit. The remaining $30,000 means he has 30 units above the exclusion limit. At 43 cents per thousand per month over 12 months, Khabib must include $154.80 in his gross income, typically reported on his W-2. If he contributed toward premiums, his taxable amount would decrease accordingly. Let's turn our attention to two important fringe benefits: employee death benefits and disability insurance. When it comes to employee death benefits, these payments are excluded from income if the employer has no obligation to pay, and the facts indicate it's a gratuitous gesture. For disability insurance, the tax treatment depends on who pays the premium. If the employer pays, benefits are taxable. But if the employee pays with after-tax dollars, benefits are excluded from income. These distinctions can significantly affect your overall tax liability, so it's crucial to understand who pays for what. Cafeteria plans give employees flexibility by allowing them to choose between cash or a range of qualified benefits. Generally, these benefits are excluded from income, provided the plan is structured properly, meaning it avoids constructive receipt, offers qualified benefits, and doesn't favor highly compensated employees. For key employees, non-taxable benefits must be less than 25% of the total provided to all staff. This design helps employers control fringe benefit costs while giving employees choices that fit their needs, making cafeteria plans a practical option in diverse workplaces. Flexible spending accounts, or FSAs, allow employees to set aside pre-tax dollars to pay for medical or dependent care expenses. Not only are these salary reductions exempt from payroll tax, but the entire elected amount is available at the start of the year, regardless of how much has been contributed so far. However, any unspent funds are forfeited at year's end, which means careful planning is essential. For 2025, the maximum healthcare FSA contribution is $3,300. FSAs offer valuable tax savings, but require you to estimate your expenses accurately. Long-term care insurance is designed to support individuals who can't perform at least 2 activities of daily living, such as eating, bathing, dressing, toileting, transferring, or maintaining continence. Employer-paid premiums are deductible for the company, and the benefits received are generally not taxable if they're under $420 per day in 2025, or equal to actual care costs. However, it's important to note that long-term care insurance isn't available through cafeteria plans or flexible spending accounts. Understanding these rules ensures you maximize both your coverage and your tax advantages. Some of the most familiar employee fringe benefits include meals, lodging, and no additional cost services. Meals and lodging must be provided for the employer's convenience and on business premises to qualify for exclusion. In addition, employers can only deduct 50% of meal costs for this purpose in 2025. Lodging also requires that accepting it is a condition of employment. For no additional cost services, like free standby flights for airline staff, the service must already be offered to customers and not create extra cost for the employer. Discriminatory plans can result in taxable benefits for highly compensated employees. Qualified employee discounts allow workers to purchase products at no more than the cost of goods, or receive up to a 20% discount on services, without those savings being counted as income. However, if the plan discriminates in favor of highly compensated employees, those individuals must include the discount as taxable income. Working condition, fringe benefits, cover items or expenses that would be deductible if the employee paid out of pocket, such as professional dues or work-related education. Recognizing these distinctions helps employees and employers manage taxable compensation more effectively. Let's take a closer look at additional employee fringe benefits, focusing on de minimis benefits and qualified transportation. De minimis fringe benefits are perks so minor, like occasional meal money for overtime or employer-provided eating facilities, that tracking their value would be impractical. These are generally excluded from taxable income. Now, when it comes to qualified transportation, employees can receive up to $325 per month for both commuting and parking in 2025. However, these transportation benefits may be discriminatory, and since the Tax Cuts and Jobs Act of 2017, employers can no longer deduct these costs. Moving expense reimbursements are another fringe benefit with changing rules. If you received qualified moving expense reimbursements before 2018 or after 2025, they can be excluded from your income if paid by your employer. But from 2018 through 2025, the exclusion is much narrower. Only members of the U.S. Armed Forces on active duty moving under military orders can exclude these reimbursements, and only for in-kind moving and storage expenses. This temporary change is set to sunset after December 31st, 2025, unless Congress extends it. Some benefits target long-term well-being. Qualified retirement planning services are tax-exempt if your employer maintains a qualified plan. This includes not just plan details, but also broad financial advice. If the benefit is discriminatory, however, highly compensated employees will have to recognize it as income. For athletic facilities, the exclusion applies only if the facility is run by the employer, located on their premises, and used primarily by employees and their families. These criteria ensure the benefit remains focused on employee wellness. Educational assistance programs can offer up to $5,250 per year, excluded from your taxable income. To qualify, employers must maintain a written plan covering tuition, fees, books, supplies, equipment, and even student loan payments made between March 28, 2020 and December 31, 2025. Both undergraduate and graduate education are eligible, but sports or hobby classes don't count. For dependent care assistance, up to $5,000 can be excluded annually, as long as the care enables you to work and the plan meets non-discrimination requirements. Let's discuss 2 more unique benefits: tuition reduction and adoption assistance. Employees of educational institutions often receive tuition reductions for undergraduate studies. Graduate tuition reductions are excluded only if teaching or research duties are performed. Adoption assistance programs allow for a maximum exclusion of $17,280 in 2025, but this phases out between incomes of $259,190 and $299,190. All adoption assistance plans must meet non-discrimination requirements to qualify for tax benefits. Achievement awards and certain military benefits also receive favorable tax treatment. Employee achievement awards must be tangible personal property. Think of items like watches or plaques, with a limit of $1,600 if the program qualifies, or $400 otherwise. Turning to combat pay and military benefits, payments such as combat zone pay, housing and subsistence allowances, and death gratuities are specifically excluded from taxable income. These exclusions acknowledge the unique nature of military service and employee recognition. Wrapping up fringe benefits, parsonage allowances and frequent flyer miles enjoy special tax exclusions. Ministers can exclude the value of a home or rental allowance provided by their congregation from taxable income, a unique benefit within the clergy community. Meanwhile, frequent flyer miles and similar promotional rewards earned from business travel aren't currently considered taxable income, according to IRS Announcement 2002-18. This policy includes points earned through hotels or car rentals that are exchanged for free upgrades or travel. Understanding how retirement plans are taxed is essential for long-term planning. The doctrine of constructive receipt means employees defer income taxes when they elect deferrals before earnings are received. Both employee deferrals and employer contributions are excluded from current income. Plan earnings grow tax-deferred until distributions begin. When you start withdrawals, typically at retirement, amounts are taxed as ordinary income and not subject to payroll taxes. Early distributions often trigger a 10% penalty, emphasizing the value of waiting until retirement age. Special retirement plan issues arise with Roth accounts like Roth 401k and Roth 403b. Unlike traditional plans, there's no tax deferral. Contributions are made with after-tax dollars. However, distributions can be completely tax-free if they're qualified. That means the account's been open at least 5 years, and distributions happen after age 59.5, disability or death. Non-qualified withdrawals are taxed proportionally on earnings and principal return. Understanding these requirements helps maximize Roth account advantages. Let's explore recent changes in Roth employer contributions under Secure 2.0. Before 2023, all employer contributions had to be pre-tax, deductible for employers, and excludable for employees. But after December 29, 2022, employees may now elect to have employer contributions made as Roth contributions instead. These are taxable to employees each year. They'll receive a Form 1099-R and follow the same withdrawal rules as Roth employee contributions. This flexibility offers new planning opportunities for retirement savers. Let's examine special retirement plan issues, focusing on stock options, a topic that often causes confusion. There are two main types: non-qualified stock options, or NQSOs, and incentive stock options, known as ISOs. For both, at the grant stage, there's no income recognized. With NQSOs, exercising your option triggers ordinary income based on the difference between market value and exercise price. When you sell, you may have either long-term or short-term capital gains. ISOs, however, only create taxable events if specific holding periods aren't met, making them attractive for tax planning. Comparing NQSOs and ISOs side by side helps clarify their tax implications. At the grant date, neither type results in immediate taxation if the strike price matches or exceeds the fair market value. When exercising NQSOs, you recognize ordinary income on the difference between market value and exercise price. ISOs don't trigger ordinary income at exercise, but may impact your alternative minimum tax. Upon sale, NQSOs can result in capital gains or losses depending on how long you've held the stock, while ISOs offer long-term capital gains if holding requirements are met. If not, part of the gain becomes ordinary income. Let's bring these concepts to life with a practical example. Valentina receives an ISO for 100 shares at $10 each. When she exercises her option at $14 per share, there's still no tax owed. Later, she sells all shares for $1,700, realizing a $700 long-term capital gain if she meets the required holding periods. But what if she sells too soon? In that case, $400 becomes ordinary income and only $300 is treated as capital gain. This demonstrates why timing and holding periods are crucial in stock option tax planning. Now let's turn to government-required benefits, essential protections for employees. Unemployment compensation is generally included in your income unless you've made after-tax contributions. Workers' compensation covers medical expenses and lost wages due to work-related injuries or illness, but those benefits are excluded from taxable income. Social Security's taxation is unique. Whether benefits are taxed depends on your modified adjusted gross income. Understanding how each benefit is taxed ensures you're not caught off guard when filing your return or making financial plans. Let's break down how modified adjusted gross income, or modified AGI, is calculated for Social Security taxation. Start with your AGI, then add back excluded municipal bond interest, foreign earned income and housing allowances, U.S. savings bond interest, adoption assistance benefits, and certain excluded territorial incomes. You'll also need to include any student loan interest you deducted. This broader definition means more of your income is considered when determining if your Social Security benefits are taxable, so it's important to keep track of all sources. Understanding how Social Security benefits are taxed begins with knowing the base and adjusted base amounts for different filing statuses. For married couples filing jointly, if your combined income passes $32,000, up to 50% of your benefits may be taxable. This threshold is just $25,000 for singles. At higher income levels, $44,000 for joint filers and $34,000 for others, up to 85% of benefits can be included in gross income. These thresholds help determine what portion of your Social Security is subject to tax, which is a key consideration for retirement planning. Let's clarify the 50% Social Security taxation rule. If your modified adjusted gross income, plus half your Social Security benefits, exceeds the base amount, but not the adjusted base amount, you must include part of your benefits in taxable income. The includable amount is whichever is less, half your total Social Security benefits, or half of the sum of your MAGI, plus half your benefits minus the base amount. This formula ensures taxation scales with income, making accurate calculation essential for effective tax planning. Consider Juliana, a single filer who receives $15,000 in Social Security, plus interest, dividends, and retirement plan income. Her combined MAGI and half her Social Security exceeds her base amount but stays below the adjusted base. In her case, she'll use the 50% formula. Half her Social Security is $7,500. Applying the second formula results in $4,250 being included in her gross income. This example highlights why it's important to track all sources of income when planning for Social Security taxation. When your income rises above the adjusted base amount, the rules change. Up to 85% of your Social Security benefits may become taxable. The includable portion is whichever is less, 85% of your total benefits or 85% of your MAGI plus half your benefits minus the adjusted base amount. Then you add the lesser of what was calculated under the 50% formula or a set dollar limit based on filing status. These formulas ensure that higher income taxpayers include a larger share of their benefits. Let's look at Andrea's case, a single taxpayer who received $15,000 in Social Security, $5,000 in interest, and $48,000 from her retirement plan. Adding her MAGI of $53,000 to half her Social Security benefits brings her total to $60,500. Since this exceeds her adjusted base amount of $34,000 for singles, Andrea must use the more complex 85% formula to calculate how much of her Social Security becomes taxable. This scenario demonstrates how higher retirement incomes can significantly affect tax liability. Here's how Andrea's taxable benefit is determined. First, calculate half her Social Security, $7,500, and apply both the 50% and 85% formulas. The key figures are $12,750 from taking 85% of her total benefits and up to $22,525 plus an additional lesser value from prior calculations. After comparing all options and applying IRS rules on limits, Andrea includes $12,750 in her gross income. This example illustrates how precise application of these formulas directly impacts what's taxed.